Did markets move before the news hit your feed? And how do you protect your trades when they do? Today we break down an unusual futures surge that shows how fast online signals can ripple across assets. Minutes before a market-moving social post by Donald Trump on March 23, 2026, volume jumped in stock index and crude oil futures. The post coincided with a sharp swing in sentiment. What stood out was the timing and the cross-asset pattern. Traders who watch headline-driven flows are dissecting the sequence as a real-time case study in price discovery during thin hours. Here's what changed versus the typical baseline. Headline sensitivity looked elevated. Equity index and energy futures appeared to react within the same window, even though no scheduled data hit. That points to faster signaling between markets. Liquidity was thinner than in regular cash sessions, which made prices more reactive to bursts of orders. With less depth in the book, a few large prints can move levels quickly. Alignment across assets tightened. Algorithms seem to be mapping political headlines to both growth and inflation proxies, linking stocks and crude more closely. And reaction cycles got shorter. The gap between an online post and visible shifts in order flow narrowed, compressing decision time for discretionary traders. Why it matters for portfolios. Abrupt futures moves can set the tone for the cash open. Index investors and ETF users may see wider opening gaps and more slippage on pre-bell orders. Staggering entries, favoring limit orders, and avoiding blind market orders around headline risk can help. For commodity and energy exposure, coordinated moves in WTI can amplify swings in energy equities and commodity-linked ETFs. Tighter stops and smaller position sizes may be warranted when the tape is headline-led. Options traders should expect skew and term structure to reprice quickly. Hedges that span both equity and crude can better reflect correlated shocks. Even credit and rates can feel second-order effects as risk appetite shifts and cross-asset VAR expands, nudging multi-asset portfolios to de-risk. The practical takeaway is simple. Treat off-hours as a different market. Monitor overnight depth and cross-asset tape. Predefine your risk and your execution method before headlines appear. When sensitivity is high, prioritize limit prices, use conditional orders, and align hedges across related assets. That preparation can turn surprise moves into managed risk instead of costly slippage. Read the full article at finlitica.com. Quick reminder. This is general information, not financial advice. Your money, your decisions, so always do your own research.